Hi, welcome to Financial Accounting, Chapter 1, Uses of Accounting Information and Financial Statements. The objectives of this chapter are to define accounting, identify business goals and activities, describing the role of accounting in making informed decisions, identifying the many users of accounting information, explaining the importance of business transactions, money measures, and separate entities to the accounting measurement process, describing the corporate form of business organization, defining financial position, and ensuring that we understand the accounting equation in light of our new variables for stockholders' equity, identify the four financial statements: the balance sheet, the income statement, the statement of retained earnings, and the statement of cash flows. State the relationship of generally accepted accounting principles, otherwise known as GAAP, to our financial statements, and the role of the CPA in assisting in the financial statement process. Lastly, we will spend some time discussing ethics and the ethical responsibilities of accountants. Today's discussion will focus on defining accounting and the uses of accounting information. So, why do we need accounting? Accountants focus on the ultimate needs of decision makers who use the accounting information. Whether those decision makers are inside or outside the organization, they need to be able to have information about that organization and how they're performing financially in order to make decisions. Accountants provide the link between the business's activities and the decisions that need to be made about the business. Accounting is not the end in itself, but is rather an information system that helps businesses to measure, process, and communicate information about an identifiable economic entity. By measure, we mean that accounting helps to record transactions. Processing data basically means taking that raw data from the transactions and making it into useful information and storing that information. And then lastly, they communicate. They help the business share the information so that the decision makers can make decisions. Essentially, accounting supplies information to decision makers that they need to make reasoned choices about the alternative uses of scarce resources in the conduct of the business and economic activities. Again, essentially, accounting provides the link between business activities and decision makers. All businesses essentially have goals, perform activities, and have some sort of performance measures to determine whether the activities of the business are helping that business to achieve its goals. Essentially, a business is an economic unit. It aims to sell goods or services to customers at a price that will ultimately provide an adequate return to its owners, the stockholders. There are many different forms of businesses, but all businesses essentially have similar goals. The goals of a business are to achieve profitability. Profitability can simply be defined as revenues greater than expenses. That's what equals profits. Businesses essentially have to make enough money to pay all the costs of doing business and have money left over as profits for the owners to want to stay in business. Essentially, if a business is not making a profit in the long term, they will go out of business because it won't be economically beneficial to the owners for that business to stay in existence. The second goal of businesses is liquidity. This is essentially what we call cash flow. It's the ability to pay bills and operate the business on a daily basis. A business must have enough cash available when its bills come due to pay them. It's the same as you and I. We need to have liquidity. We need to have cash in our pocket to be able to pay our bills. So those are the two primary goals of all businesses: profitability and liquidity. The goals of a business are basically achieved by pursuing whatever the activities are of that business. The business activities can be broken down into three primary categories. First, we have financing activities. Financing activities are those activities which obtain capital from owners, which is primarily focused on issuing stock, and creditors, which is essentially borrowing money. And then we have to repay those creditors who we borrowed the money from, and we also have to provide some sort of return to our owners. We provide a return to our owners in the form of dividends. The second type of business activity are investing activities. Those are the investing activities are those such as spending the capital in ways that are productive and will help the business achieve its objectives. And then secondly, buying and selling assets such as equipment and financial instruments that are used in the business. So for instance, a capital investment would be when a business purchases a new manufacturing line in order to maybe make itself more productive. That would be an investment or an investing activity. And lastly, operating activities. These are the daily operations of that business, the selling of the goods or services to its customers that generate all the sales and expenses of that business on a daily basis. This is employing managers, workers, buying our products, selling our products, paying our fees, doing all the activities of that business on a daily basis. Those make up the operating activities. So essentially, the activities of a business are financing activities, investing activities, and operating activities. All functions of the business can be broken down into those three different categories. Once the business is performing those three different types of activities we discussed, the business also has to establish measures to determine how well it is performing those activities, to determine if it is achieving its goals. So a business, just like you and I, we establish goals for ourselves. You might have, say, a goal to get an A in college accounting. In order to get that A, you need to determine what types of activities you need to perform, whether it's studying, reviewing your notes, doing your homework assignments, etc. You establish those activities, and then you need to determine what types of things you're going to do to measure whether you're successful at those activities. You might measure it based on grades, etc. Well, businesses do those types of things as well. They establish measures to determine whether they're achieving their goals based on the activities that they're performing. So performance measures indicate whether or not managers are achieving the business's goals and if they are managing the business activities well. Businesses establish performance measures including earnings, cash flow, and they use things called ratios to help them determine whether they're achieving their performance goals. So for instance, a business might have a certain profitability goal, or they might have a certain cash flow goal. If you remember, we talked about profitability, okay, previous slide, and we talked about cash flow in terms of liquidity. And the ratios will help to determine whether they're meeting earnings and cash flow goals. Managers must be able to understand and evaluate their measures. They must make sure that measures are aligned to the business goals. They generally will have multiple different measures to help them to evaluate different business goals, and the measures must be basically realistic and crafted to motivate managers to help them achieve the goals. Lastly, they also want to make sure that they have established goals that help them to determine whether improvements need to be made. So they might be achieving a goal, but they might also decide that the goal is too low. Maybe they could be doing better. Those are things that the measures will help them to determine. So the question we have at the end of this discussion is, what is the difference between profitability and liquidity? That concludes our discussion of defining accounting, identifying the business's goals and activities, and describing the role of accounting in helping managers both inside the organization and outside the organization make informed decisions about a business. To answer the questions for the end of this section of notes, please click in the corresponding boxes for each question to answer that question, and at the end, please click the Submit button to submit your responses. Thank you.